Welcome, everyone. Today, we are decoding a secret language of the stock market that literally every successful trader uses. Have you ever stared at a price chart and wondered what all those red and green bars actually mean? Well, by the end of this explainer, you're going to be reading the market's mind. Okay, let's dive right into this. We've broken this down into 6 logical buckets so you don't feel overwhelmed. First, candle anatomy. Then we'll look at the twins part 1 and 2, followed by the extremes, indecision, and finally, some absolutely crucial pro rules. Let's get started. Section 1. Candle Anatomy. The building blocks of the market. To read the story of the market, we've got to learn its alphabet first. Think of every single candle as a tiny battlefield, where buyers, the bulls, and sellers, the bears, are fighting it out. There are 2 main parts here. That thick part in the middle, that's the body. And those thin lines stretching out, we call those the wicks or shadows. Now, the body shows you exactly where the price opened and closed. But the wicks are super important. They show us the absolute extreme highs and lows reached during that specific time frame. So what about the colors? A green candle simply means the price closed higher than it opened. The buyers won that session, making it bullish. A red candle, on the other hand, means the price closed lower than it opened. The sellers took control, making it bearish. The wicks might look exactly the same, but the battle's winner comes down purely to where that price opened versus where it closed. Moving on to Section 2, Hammer and Hanging Man. Context is king. Look really closely at these 2. Visually, they're totally identical. They both have a small body at the top and a long lower wick that's about twice the size of the body. But here is the catch. Their placement changes literally everything. In the market, a candle's shape is only half the story. The trend happening before the candle is what truly matters. If you spot this shape at the bottom of a downtrend, it's called a hammer. That means buyers are stepping back in, signaling a bullish reversal. But if you see that exact same shape at the top of an uptrend, that's a hanging man, which is a major warning that sellers might be about to drag the market down. So the absolutely crucial point here is, for these specific twins, color completely does not matter. A hair can be red or green. A hanging man can be red or green. It's all about whether the prior trend was pointing up or pointing down. Don't make the rookie mistake of blindly buying just because you see a green hanging man. Let me ask you something to think about. If context is so much more important than shape, why do you think a candle that looks exactly like an upside-down hammer goes by 2 completely different names? Section 3, Shooting Star and Inverted Hammer, the upside-down twins. So these look exactly like hammers flipped upside down. The psychology behind them is absolutely fascinating. That really long upper wick, it means buyers tried to push the price way up, but the sellers fought back incredibly hard and pushed the price right back down. Now, if this battle happens in an uptrend, it's a shooting star, which is a bearish signal. But if that exact same battle happens at the bottom of a downtrend, it's an inverted hammer. That means the bulls are finally waking up and trying to force a reversal. And once again, red-green, the color doesn't matter. Section 4. The impact of Marubozu. Total market dominance. Let's shift gears from long wicks to absolute extremes. Meet the Marubozu. In Japanese, this translates to bald man or dominance. This is a candlestick with a massive, long, solid body and absolutely 0 wicks, or, maybe really tiny ones. But the complete lack of wicks means something very specific. There was 0 pushback. Whoever took control at the open completely dominated the session all the way to the closing bell. Now, what's really interesting here is that our previous rules completely flip. For Marubozu, color is absolutely everything, and the prior trend doesn't matter at all. A solid green Marubozu is wildly bullish. Buyers are completely in charge, regardless of what happened yesterday. And a solid red Marubozu means sellers are dominating with intense downward momentum. Again, the trend doesn't matter here. Dominance is dominance. Section 5. Spinning Top and Doji. Indecision, or the battle of equals. What happens when neither buyers nor sellers can get the upper hand? You get pure market indecision. First up is the spinning top. It looks exactly like a little spinning top toy, a small body right in the middle with long wicks on both the top and bottom. Then we have the doji. A doji takes this a step further. It basically has no body at all. The open and close prices are exactly the same. It is a perfect dead tie. Now, dojis have a couple of specific, very powerful variations. Take the dragonfly doji, which looks like a capital T. If you find this in a downtrend, it tells us sellers pushed the price way down, but buyers yanked it right back up to the open. That's a strong bullish signal. The total opposite of that is the gravestone doji, shaped like an inverted T. Finding this at the top of an uptrend is literally like finding a gravestone for that rally. It's highly bearish and signals a shifting tide.
Section 6. Essential Trading Rules. Execution and Risk Management.
And this brilliantly illustrates why just knowing the patterns isn't enough. Let's talk about execution. Pros use a strict 4-step framework for this. Step 1. Always confirm the prior trend. Step 2. Identify your candlestick pattern. Step 3, and this is absolutely vital, never enter the trade on the pattern candle itself. Always wait to enter above or below the next candle. And Step 4. Always set your stop loss at the extreme end of the wick to protect your capital. Protecting your capital is the name of the game. That's why you have to follow the golden rule of targeting. Always aim for a risk-to-reward ratio of 1 to 2. If your stop loss risks 10 points, your absolute minimum target should be 20 points. Aiming for at least double what you're risking is what keeps you consistently profitable in the long run. Let's hit some rapid-fire pro tips. Candlestick patterns aren't magic, and false signals happen all the time in the market. Never trade without a stop loss, period. Second, always confirm these patterns using a volume indicator. A pattern candle with higher volume is a much stronger signal. And here's a great little hack. On platforms like TradingView, you can just type the pattern name into your indicators and it will automatically scan and highlight them on your chart for you. Take a mental snapshot of this. This is your ultimate cheat sheet, summarizing everything we've just covered. Notice how both the hammer and the inverted hammer require a downtrend, and color completely doesn't matter. On the flip side, the Marubozu is the rebel of the group, where color is absolutely everything, and the trend doesn't matter. Understanding this logical breakdown is going to help you filter out so much noise on the charts. So, you've learned the alphabet of the market. You know the words. But the real question is, when the market opens tomorrow, are you ready to read the story the charts are going to tell you? Apply these patterns, stick to your risk management, and watch how the battlefield reveals its next move. Keep learning, keep analyzing, and we'll catch you in the next explainer.